FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz. It's November 7th, 2017. The year is almost over, so it's a good time to go take a look at what the markets have done, what investing trends have paid off big this year, and what perhaps you should be doing. And Sam McElroy is with us now from @financial.com, atfinancial.com. Sam, welcome back.
Hey, thanks for having me.
So those one decision stocks, they kind of remind me of the Nifty 50 from the 70s. They really came through for the year. They really performed. You didn't really need to do much other than to invest in Apple, Google, Facebook, and pick a couple of others, and you were home free.
Yeah, that's absolutely true. It's been such a really interesting year because it's been such a mixed bag. Some of the stocks, like ones that you were talking about, Facebook, Apple, Google, whoever it might be, just had tremendous years. But then there's also a handful of stocks. I'd throw GE in there that's just had a horrible time this year. And so anybody who's been trying to do individual stock selection, may have either, hit it big or kind of struck out here. But it's definitely a year where there's been some tremendous winners and probably some, quote unquote losers as well.
Right. So, is it just momentum? Is it just flow of funds? All the money is going into those dozen or so high-performing, high-profit stocks? Or are we going to see that you need to be more of a stock picker in the year coming up?
I think it's a convergence of a couple different variables. Part of it is related to sector. I think that technology and other sectors have just had advances and other things that have made money flow into them. But I think the other part of it is that in general, we've been experiencing some highs and some good points just for the U.S. stock market as a whole. And I think that one of the reasons that we're seeing that partially is just investor optimism, investor behavior, because they're almost in a sense willing the market to continue higher. But I think it's also that there's not a whole lot of places to put money these days. People are looking at some of the things that are happening globally and feeling like they may not want to put their money in some of these other emerging markets or even established foreign markets. But in addition to that, they're still looking at interest rates and they're saying, okay, well, interest rates haven't really moved much, so I don't know if I want to put money there. And if people are starting to target the U.S. stock market as a place where they didn't want to put their capital, I think a lot of people are starting to look at some of the years that some of these companies have had, and they said, okay, well, let me kind of double down on the market and not just go into it wholeheartedly or blindly, but maybe pick some of these stocks that are going to have a really good year.
Yeah.
So you see things like Apple, who I think is up like 42% for the year, and Facebook, who I think was up over 50% for the year. And people are being rewarded for basically some of those riskier maneuvers that they're making, which in a sense is a self-fulfilling prophecy, because then they feel like, okay, well, let me do more of this and see if I can get a bigger reward. One of the problems that you get into, though, is that it becomes really, really hard to consistently be right when you're doing stock picking.
Mm-hmm. Yeah, well, so most of your colleagues out there, they're just going for the low-hanging fruit, the easy way? Is that what's happening? It gets to the point where these valuations are so distorted. And then Tesla was a huge performer, and we finally saw the fall of Tesla. Are we going to see other companies similar denouement?
Yeah, it's hard to tell, but you hit on a couple really key pieces. A lot of the times when people are investing, they're so removed from the company they're investing in that they view it as, that the market or the stock is either going to go up or down. And if it's doing good, then it's going to, there's this perception that it's just going to go up. And if they're up, that's great. But what they miss is that whenever they're buying a stock, they're really buying a minority ownership interest in that company. They should view it almost as if they're, investing in and buying a company. And that's where the whole valuation comes into it. I think that people often underestimate valuations for companies and paying attention to some of the other key ratios as far as whether or not it's a good investment. What they really look at is, do they think they can make some money in the short term or in the long term? So I think that a lot of the valuations for many of these companies have become really exorbitant. And the question is, what's going to happen to rectify that situation? Either the share values are going to fall so that the PE ratios become more in alignment with the earnings of the corporation, or it's at least going to stall out for a little bit so that the company can grow into its inflated prices. I think both of those are potentially bad for investors that are going to be in those stocks. And I think one of the issues that we're going to have to watch out for is we got to remember that while some people maybe hold a lot of individual stocks, there's a lot of money in retirement accounts. And retirement accounts by nature are going to be primarily invested in more funds. And if people start to panic and start to sell out of a lot of these funds and ETFs, that's going to affect individual stocks, even if that stock is still a good stock to hold. So I think one of the things you might see is if the market starts to waver or have a correction and people start blindly selling out of 401ks and 403bs and stuff like that, that may end up having this phenomenon where all ships rise and fall with the tide. And you may start to see share values, for companies that have been doing really well, like Facebook and like Apple, actually have some problems also.
Now, what about the fact that interest rates have gone up, a few minor hikes, 3, I guess, and there's a possibility that we're going to see more. You think you concerned about this as far as its impact upon the market? Nowadays, I remember in the good old days, when the Fed was tightening, that was always a bad thing for the stock market. Nowadays, it seems to be a justification for it to go higher.
I know. It seems like everything, all the old axioms that you used to follow kind of just don't make sense anymore. But, I guess there are a couple of concerns there. I think just from a global economic standpoint, we don't want to stay in prolonged low interest rate environments indefinitely. So at some point, I think we need to see a return kind of reversion back to the norm, I guess, or towards the mean or towards the average. However, we've seen a couple token small interest rate hikes. I think that the Fed is really handcuffed in its capacity to raise interest rates because we haven't seen a lot of movement in long-term interest rates. And in a sense, people talk about the yield curve, what they're really saying in simple terms is that if short-term interest rates rise, but long-term interest rates don't, then you end up with this flattening of the yield curve. And anytime that happens, it disincentivizes banks to want to lend money. And if people are using that money for mortgages and cars and things that were kind of spurring GDP growth, if that were to tighten, then that could be negative for the economy as a whole. And I think that's why we haven't seen a lot of interest rate increases. So I see this interconnectedness, even though there's not supposed to be, between the Fed and between Wall Street, where they're kind of making sure that it's okay to do these interest rate increases. So I'm not so concerned that these small token ones are going to negatively impact the market. But I think at some point, interest rates are going to have to start to creep back up. And the interesting thing I think for all of us to look at is if interest rates do start to increase and the market starts to falter, are some people going to feel like now it's time to take some chips off the table and maybe move into some more conservative or safer investments? And could that kind of tip this overvalued market?
Yeah, well, they are tied. And you have to look at Trump's new Fed chair appointee, Powell, who apparently is a dove in terms of interest rate policy, and wonder, but all they've done by increasing short-term rates here, Sam, is flatten out the yield curve. Really, it's like you said, the long-term rates have not gone up accordingly, and certainly we know they can somewhat control them through quantitative easing. But nobody seems real anxious to re-implement that in light of the fact that the economy might not be booming, but it's certainly not crashing through the floor yet. But that's always a possibility. So I guess we then look at investment alternatives. What does the average person have? Yeah, obviously, you work for a company or governmental entity, and they provide you with a pension plan, which is happening less and less now, of course. It's going to be invested in stocks. But then, you have to look at real estate, perhaps in less inflated markets, talking about away from the coasts, more in the heartland of the country. Mm-hmm. Is that a good play for your typical investor?
It could be. It depends on how they're going to and what access to real estate they have. I think the bigger question is anytime you're in a period of heightened uncertainty and, all the speculating that we're kind of doing, talking about what could happen with the market and with some of these stocks and with interest rates, basically is because we're in a period where it's looking murkier and murkier as far as what's going to happen next. And anytime that happens, it becomes really important for average investors to hyper-focus on purpose-based investing. What that means is that you really got to start to look at what is your objective and what is it that you're trying to do. You can't simply just say, well, I'm seeking return just for the sake of getting return. You got to start to break it apart. Am I looking to make a lump sum purchase at some point in the future where I'm going to need to take a large distribution out of my assets? Am I looking to generate income? Am I looking to, maximize an inheritance to somebody? And then really making sure that the investments you're purchasing line up with the purpose for which you're investing. So don't invest for maximum growth if what you really need is income, and vice versa. If what you need is long-term growth, then you don't necessarily need to be as nervous about the market. And in a sense, if you can make sure that your purpose lines up with the investments you're buying, you can start to really insulate yourself from some of these unknown variables that you aren't going to be able to see coming until it actually starts to manifest itself.
Right. All right. Well, that's a reasonable. And as far as the market taking a hit in the future, just like it has in the past many times. I mean, look, Sam, every boom ends with a bust, right? What's the likelihood here?
It's hard to say. Based off of my analysis, I think we're due for a significant correction. Truthfully, I'd have thought that it would have happened already by now, maybe in the last year or two. But I think there's a lot of additional factors that's kind of bolstering the market right now. But I don't feel like this recovery that we're experiencing since 2009 could be a permanent recovery. I think there's too many things that are indicating that at some point we're going to need to have a significant correction to shed some excess baggage before we get into a period of really good, sustainable growth again. Now, having said that, I don't have a crystal ball. And the market could do really well this year, could be up, really well next year. I think there's a lot of pieces that we just don't know yet to be able to tell what direction it's going to go. But I think what we do know is that the prime is pumped. I think that the stage is set for the market to start to slide and to start to have some volatility. And I think it's really important that when people keep hearing about all-time highs, that they really start thinking about starting to take steps down the risk ladder. Mm-hmm. We always talk about buy low and sell high. And I think one of the only ways to do that is to have the courage to take some chips off the table when things are going really, really well, so that when things aren't going so well, you have money that's ready to be reinvested at that low point.
It sounds like a reasonable approach. Well, Sam, thanks for helping us out on this subject. It's real difficult to know when to double up, when to hold, when to fold, and when to run. And we could be getting close to the time where you need to run. Hey, just tell us again, best place to find you and connect with you on the web.
Yeah, so easiest way is probably our website, www.financial.com.
All right, and we'll have a link to it in the show notes to this interview on Financial Survival Network. Make sure you sign up for the newsletter. Email us, be part of the show, kl@kerrylutz.com. I'm catching up on a vast abundance of emails that you've been kind enough to send, but I will answer them all eventually. Some of them actually require some research, getting information, because I don't want you to get the wrong ideas. And of course, the Twitter feed is @KerryLutz. The Facebook page is Financial Survival Network. Sam, thanks so much for coming on. We'll talk to you again real soon.
Okay, thanks so much.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.